So let's now look at some specific interest rate futures that trade on the CME exchange. Okay. By the way, this CME page that you see here, it's a very nice resource to learn about interest rate futures. So they have a lot of papers and information and really helpful stuff to learn about these products. Okay, so I recommend that if you want to dig in deeper into some of these things, come to this webpage and you'll find again lots of information here. Okay, so we will look at two specific futures. One will be the U.S. Treasuries futures, and the other one, which we'll do right now, it's this one, the Eurodollar futures. Okay. All right, so what is this? What is the Eurodollar futures? This is basically a future contract whose underlying is the 3-month US dollar LIBOR rate. Okay, so going into the specific page for the Eurodollar, what you have here are the quotes for the different futures. So right now, today, February 17th of February, you can trade the futures for March this year, April this year, May, and so on. A bunch of different futures that extend to several years. Okay, so it's a very long market. Each one of these futures. So this future is for the 3-month LIBOR that starts in March this year. This contract is for the 3-month LIBOR that starts here, and so on. Okay. Now, there is something a bit weird here, because if you look at the price of the future, this clearly is not a number like an interest rate. Okay, so this is something different, and let's understand exactly how these futures are quoted. Okay. So here, the idea is the following. What you see there on the CME website is what we are denoting here by this Q. Okay, so this is the price of the futures, or the quote, at the current date today, small t, for a maturity capital TF, which in the CME page that we just saw would be, for example, the March futures. Okay, so that number that you take from the web page, that 99 point something that was there, you divide that by 100, and just to make it a fractional number, and that is equal to 1 minus the forward rate. So we are denoting that by F to stress that it is a forward rate implied in the Eurodollar contract. That's what this E dollar means. Since this refers to the 3-month LIBOR, so there are 4 periods per year, I'm putting a 4 here to stress that this is an annual rate with quarterly compounding. And so that is the rate that is implied by that number that you see on the web page. So in other words, if you solve for the rate, you take the quote from the web page, divide by 100, and 1 minus that is actually the interest rate that is implied by the futures contract. Okay, so for example, a price of 97.45 means a rate of 2.55%. All right. At the expiration date of the contract, the quote is the actual LIBOR that you observe on the market. So this equation that you see here is here using the actual LIBOR. Okay, so the quote converges to what is implied by the LIBOR that you actually see in the market. All right. So this is a bit confusing at first. We are writing a contract whose underlying is an interest rate, but we are putting this additional layer of complication, which is to use this artificial bond to intermediate between the rates and the futures. Okay, so let's look at this in different angles to see what it means. So first, let's compare it to an interest rate swap, right? So the final cash flow that goes to the long side of the futures is the final price of the future, which we just discussed, has to converge to what is implied by the actual LIBOR, minus the initial price at which we enter the futures in the beginning date, in this small t, right? Which, as you can see up here, is related to the forward rate. So if you replace the forward rate and the LIBOR here, what you get is that the final cash flow to the long futures is proportional to this fixed rate minus the floating rate. Okay, so this looks exactly like a swap, where you are paying floating and receiving fixed. Okay, this fixed is the rate that is determined when you enter the contract. Okay, by the quote you see on the market at that date when you enter the contract. Right? So I'm calling this. I'm saying that this is similar to a swap, but this is really just a swap with one payment, which would be what we called a forward rate agreement some videos ago. Okay. All right, but the futures is actually written on, or the quote is actually like a bond price, as we just saw, and the reason for that is that we want the futures to be on something that moves like a bond. Okay, so if you note that the quote is related to the forward rate like this, we have the inverse relation between interest rates and bond prices that we have with real bonds. Okay, so if that forward rate goes up, the quote of the futures goes down. Okay, and then when I'm doing the mark to market every day of my positions, this behaves exactly like if it was a futures on a real bond. So if I have a long position in the futures, if the bond price goes down, I suffer a loss. Okay, and the other side of the contract gains, has a profit. Okay, and vice versa. If interest rate goes in the other direction, the payoff is the opposite, right? So at each day, I can compute the profit or loss, so do the mark to market, by just treating that quote as if it was the price of a bond. So looking at the price today, comparing that to the price at the end of the previous day, and multiply by the notional. And there is this 1/4 here, which is not so obvious, but it's because when I replace this cube by the rates, I am using annual rates with quarterly compounding, so those have to be divided by 4. Okay. All right, so how do we use these Eurodollar futures to hedge? Okay, so since we have this artificial bond in between, we can use it, or we can think about it just like we did for a forward contract in the previous section. So for example, if I am going to invest money in the future, and I want to guarantee the rate at which I will invest, since making an investment is the same as buying a bond, what I want to do is to fix today the price at which I will buy the bond in the future, meaning that I will go long in the Eurodollar futures. Exactly the same reasoning as we did for a forward agreement in the previous section. Okay. However, there will be a slight difference now, as we will see in this example, right? So let's say that it is May, and an investor wants to lock in the interest rate for a 3-month investment beginning in September, right? So I look at the market right now at the CME webpage, and I see that, for example, the quote for that month where the investment will start, September, is 96.5. Okay. So from that quote, I can immediately get the implied rate that I can lock in. Right. So let me open the timeline here. All right. So again, it is May today. The market is this. I can observe the futures quote at 96.5. I want to lock in an investment that will start in September. This is what we call TF, right? I want to fix this rate. So if I use these futures, what rate am I guaranteeing? So the forward rate that is implied by this quote is, again, it's what is left to 100, so 3.5%, right? What is my strategy? Well, an investment is the same as buying a bond. Therefore, I want to go long in the futures to guarantee the buying price. So buy, in this case, 100 contracts because I want to invest 100 million and each contract is for 1 million, right? So now this is where things are a little bit different from what happens in the simple forward contract as we discussed before. Okay, so let's check if this works. So let's assume some rate for the LIBOR, the 3-month LIBOR when we get to the delivery date. So let's say in September. So when we get there, the market is this 3.6%. Okay, the futures has to converge to the quote implied by this LIBOR. So it's 100 minus 2.6, which is 97.4. Okay, so that will be the quote of the futures on the last day of trading. What is the cash flow to the long futures? The notional, the $100 million that we want to invest, times the difference between the final bond price and the initial bond price, which is up there, 96.5, okay? Divided by one quarter, as we saw before. So doing this calculation, we get a positive cash flow to long futures of $225,000. How much money do I have to invest at this moment? Well, the 100 million that came from somewhere else, plus the payoff from the futures. So the total amount that I will have here at the end of the 3 months is the money I start with, this whole thing, compounded at this LIBOR rate for 3 months. Okay, so that's how much I get, $100.86 million at the end of this period, right? So what I have is this payoff. I was hedging an investment of 100 million. I get to the end with this amount. So now let's compute the effective rate on my investment. And I want a rate with quarterly compounding such that I can compare with this rate that I was trying to guarantee, this 3.5, which is also an F4, quarterly compounding. So let's solve for a K like this. And doing the calculation, I get this number here, okay? So this number is close, but not exactly equal to the 3.5% that I was guessing here in the beginning, right? This 3.5%. And the reason for this, so the difference is not huge, right? It's a very small difference. But the reason is what? The reason is that the LIBOR rate, as it is defined in the market, calls for payment at the end of the term, right? As usual. So if I borrow money at the LIBOR rate, I will only pay interest at the end of the 3-month period. However, the futures contract is being settled. This payment is happening right here at time TF, not at the end of the 3 months. Okay, and it is not being corrected by this time difference, right? So that creates a bit of a mismatch between this rate and what I really get once I really do the investment and get the interest in the end rather than in the beginning. Okay,